Good day friends, welcome to the lecture series on mutual funds. In my previous lectures on mutual funds, I talked about what is mutual fund, what are the benefits of investing through mutual funds, how mutual funds operates, the structure of the mutual fund industry, and we were talking about the different types of schemes. In my immediate preceding lecture on mutual fund, I talked about the equity funds and the debt funds, and the tax implication of investing in the equity fund and the debt fund. Now I'll be talking of different type of other schemes which are being offered by the mutual fund houses or mutual fund managers, right? So one of the scheme is called hybrid funds. What is hybrid fund? As the name itself suggests, which is a mixture of equity and debt. So within the hybrid fund, there are funds which mainly predominantly invest in equity and less degree of debt. There are other funds which mainly invest in the debt and some degree of equity investment is there. So it's a mixture of hybrid, means mixture of the debt and the equity. So one type of hybrid fund is equity oriented funds. An equity oriented hybrid fund invests at least 65% of its total assets in equity. When I use the word total assets, means the pooled resources which investor has given to the fund manager to invest in that scheme, right? So 65% of the total assets in equity and equity related instruments of the companies across various market capitalization and sector. When I say market capitalization, means when I was talking of equity schemes, I said large cap funds, mid cap funds, small cap funds, multi cap funds. So depending on the market capitalization. And what is market capitalization? Let me repeat, which I talked earlier also. Market capitalization means number of shares floated in the market multiplied by the current market price of that share. That is called market capitalization. Right? So on the basis of market capitalization, like we say Reliance Industries Limited, TCS, HDFC Bank, HDFC, these are the Reliance Industries, these are the companies which high market capitalization, right? So these are the companies which have a large floating stock. Floating stock means number of shares issued in the market multiplied by its market price. So that is called, that makes the market capitalization of a company, right? So depending on the various types of market capitalization, large cap, mid cap, small cap, they invest mainly 65% in equity and less in the debt and other securities. On the other hand, in the debt oriented funds, at least a debt-oriented hybrid fund invests 60% of its total assets in fixed income securities like bonds, debentures, government securities, etc., and rest in equity and other asset classes. So this is called debt-oriented. Balanced fund. These schemes invest a minimum of 40% and a maximum of 60% in both equity and debt asset classes, right? So depending on the level of market, these balanced funds keeps on changing the proportion of equity and debt, right? So when the equity market is booming, equity market is very high, fund manager feels that it is a time to book profit. So then they switch from equity to debt. When I say switch, means they increase their exposure in debt assets and decrease their exposure in equity assets, and vice versa. When market is falling, fund manager feels that it is the time to invest in equity. Equities are at low prices. When I say equity, means shares, right? So at that time, fund manager increases its exposure under that scheme in the equity shares and increases and decreases its exposure in the debt schemes. So it is called balanced fund, where is a mixture of the equity and the debt, and since it is the name itself says it is a hybrid fund, so the proportion of equity and debt keeps on changing. There is another scheme called hybrid, under the hybrid fund, monthly income plans. Some investor wants, like say for example, a retiree person who wants a regular monthly income, a person who doesn't have a regular income, who is not in the job, and that person doesn't have a regular income. So that person may want that by investing in the mutual fund, the investor should get some monthly income. So there are fund managers, there are fund houses, there are mutual fund asset management companies which offer schemes which offers monthly income to the investors. So monthly income plans are hybrid plans which primarily invest in fixed income securities and allocate a small proportion of their corpus to equity and equity related instruments. Because in the monthly income plans, fund manager is under an obligation to give a fixed monthly income to the investors. That's why, and debt are more are considered as a less risky asset, and they give a regular income because the investment is in the fixed income securities, so that by that income the fund manager can give a monthly income to its investors. Multi-asset allocation fund. As this name itself says, in this the fund manager invests in different asset classes. It can be bonds, it can be equity, it can be gold, right? So different asset classes the fund manager invests. These schemes need to have an investment in at least 3 asset classes. As I said, 3 asset classes, it may be bond, equity and gold. So 3 asset classes with a minimum of at least 10% in each of the asset class. I am saying this is the minimum, right? So supposing fund manager is investing by and large in equity and debt. So at least 10% of its exposure will be in the gold. So 10% of its, suppose the corpus of the fund manager is 100 crore rupees in this. So at least minimum 10 crore must be invested in gold, or minimum 10 crore must be invested in bond, or minimum 10 crore must be invested in equity, right? So at least 10% of exposure in one of the asset class. These funds gives the investors the exposure to investing in more asset classes. Means risk is being diversified. The idea of this multi-cap asset allocation fund is that risk is being diversified. If one of the asset class increases, the value of one of the asset classes increases, the benefit of that can come to the investors. This is the idea of multi-asset allocation fund. Similarly, dynamic asset allocation fund. As I was saying earlier also, in this dynamic funds or dynamic asset allocation fund, the fund manager keeps on changing the proportion of assets in that scheme. That is, when the fund manager invests in equity and debt securities depending on the current market condition, with no specific percentage being allocated to the debt and equity. Means when the fund manager comes out with a scheme, it is not being fixed in advance that minimum this much will be in equity and minimum this much will be in the debt. There is no such fixed percentage. Depending on the fund manager market conditions, fund manager in its own wisdom, in his own wisdom or in her own wisdom, will take decision whether to allocate more asset in equity or in debt, right? So it is called dynamic asset allocation fund. Fund managers keeps on changing the proportion of equity, debt and other asset classes depending on the level of the market. Arbitrage funds. See friends, sometime you have the arbitrage opportunity. What is arbitrage? Just to speak in layman language, I will say buying in the one market and selling in the other market and thereby making profit. Sometimes there is maybe a difference between the one market, the price of the one market and the other market. So what you do, that immediately you buy in the one market and immediately you sell in the second market where there is a price difference. This is called arbitrage, right? So arbitrage funds buy stock at lower prices in one market and sell it at a higher price in another, right? These days, friends, since most of the exchanges are electronic, rather I would say all the exchanges are electronic, so finding arbitrage opportunity is a very difficult task. But still, there are various ways, especially in the future market, option market and the future market, it is possible to have some arbitrage opportunities. So these fund managers buy stock at lower price and sell it in the higher price market. So the fund manager constantly keeps looking for arbitrage opportunities and maximize the fund's returns, right? So arbitrage opportunity, I have already told you that buying at a lower price in one market and selling it, because normally the price difference may be there, may not be there for a long period. So this is the immediate action normally the fund managers take, right? So they do it immediately. So and in this way they tries to increase the return of the investors. However, there are times when good arbitrage opportunities are not available. During such times, the fund manager invests mainly in debt securities and cash, right? So this is about arbitrage, and these are just some of the schemes of arbitrage schemes, right? The hybrid funds schemes like Canara Robeco Equity Hybrid Fund, Edelweiss Arbitrage Funds, ICICI Prudential MultiAsset Fund, Canara Robeco Conservative Hybrid Fund, Invesco India Dynamic Equity Funds. Friends, this list is not exhaustive. I've just for the name's sake, I have written some of the schemes that which are popular among the investor and which have a large pooled resources, right? So the category name is also given. Now, other type of schemes in the mutual fund is called solution oriented funds. Solution oriented fund means these are for a specific objective, right? These are special solutions for your specific goals. Like at present I am earning, tomorrow I am going to retire. So I want to make a plan for my retirement, that you start your job in the age of 25 and you feel that you will be retiring, and you know it, rather I would say, that in the age of 60 you will be retiring, right? So after your retirement you will not have any regular income. For that period you make some investments so that after the retirement, when you will not be having regular income, even at that point of time you can have a regular income, right? Regular income means not from your job but from your investments. So for this very purpose certain plans are being made. So where the investment is being made for the long term by the investors, and once a person retires or at the time of retirement, he can have a regular income flow, or he can have a corpus with which he can or she can have a good life and can meet out its day-to-day expenses. So these plans are aimed at planning for the retirement. Also such tools come with a mandatory lock-in period of 5 years. Like say when you are investing in retirement plans, at least your investment should be 5 years. I mean, there is no rule as such, depending on the scheme, depending when any mutual fund house comes with a mutual fund offer, there are various terms and conditions which they put. So there can be condition of 5 years, there may not be condition of 5 years. So without the benefit of premature withdrawal, such transition lock-in period aims to ensure individual keep the corpus for a stipulated amount of time for maximum gains. So means basically these retirement planning mutual fund schemes are being offered for the long term period, right? Children plans mutual fund. Children plans means these days, as all of us know, the education has become expensive, higher education has become expensive, right? So you want to plan for the future of your child, for their marriages, for their higher education, for anything you were planning for your children. So right, so SEBI mandatory mutual funds are primarily chosen by individuals for capital appreciation of the corpus invested. Returns generated through such schemes can be used to fund higher education costs and marriage expenses of the children, or for other corresponding funding requirements, right? So these schemes are being offered for your children's plan, means to meet out the expenses which the individual is going to make for their children, right? For these expenses, these children's plans are being designed. So some popular schemes are ICICI Prudential Retirement Plan, Nippon India Retirement Fund, HDFC Children's Gilt Investment Plan, UTI CCF Investment Plans Growth, right? And on the right hand side, the category name is given: Retirement Fund, Retirement Fund. So first two are retirement funds, the bottom two are the children's fund, children, right? Now other method of classifying the schemes of the mutual fund is on the basis of load. What is load? Load means that mutual fund schemes or mutual fund companies, I would say in a very simplistic words, that if you invest before a particular period of time, then some amount of load will be charged on the investor. So this is called load. Supposing you are investing in a scheme. Today you invest, and after 2 months, after 1 month, you want to withdraw the money. Because see, when the individual invest, there are certain administrative expenses which are being incurred by the mutual fund house. So if you invest before the particular scheduled time, then the investor, depending on the scheme, may have to pay a small charges. It may be 0.25%, it may be 0.5% of the investment, right? So this is called load funds. So a mutual fund load is a fee charged for the purchase or sale of a mutual funds, right? So loads charged upon purchase of funds shares are called front-end loads, and the load charged upon the sale of funds are called the lock-end funds, right? So the lock-end funds, back-end funds means are those funds which the charges being charged at the time of redemption, right? Front-end load means the charge that is being charged at the time of the investment, right? So, but again, the SEBI has made the rules very stringent, and these days the loads are very, very low, and even at the entry point in most of the schemes there is low load as the entry point, only at the exit, and that too if you are redeeming it before a period of time, then only this load is being charged. Funds that charge as loads are generally referred to as load funds, right? And funds that do not charge any load, they are called no load funds. So funds that do not charge any load are called no load funds. A no load funds is a mutual fund in which shares are sold without a commission or a sales charge. Similarly, other method of classifying the different schemes of the mutual fund is on the basis of location of investors, right? Means if you are offering the scheme for your domestic investors, it is called domestic funds. Domestic funds are those funds which can be subscribed only by the native investors of the country. Native investors, the resident of that country. Most of the Indian mutual funds are domestic mutual funds. Offshore funds means that you offer to the non-resident Indians, right? So these are the funds which are subscribed by the people living abroad. They are a valuable source of attracting much needed foreign capital in the country, right? Those say for example, it is not necessary that only the Indians who have settled abroad and have got the citizen abroad, they are entitled for it. But supposing you want the other people who are basically focus is that those Indians who have settled outside India and they have become the resident of that India, but their roots are still in India, and you want to get a foreign capital, and you are offering the scheme for the offshore funds through offshore funds, right? So these offshore funds are basically targeted to the subscribers, to the investors who are settled abroad. In this way, you can get, the fund manager can get foreign capital, right? Other scheme is called, these are called special schemes, funds of funds. What is funds of funds? In the funds of funds, I mean, the fund manager invests in the basket. Normally what the fund manager does, the fund manager invests in either equity, debt or gold or whatever the asset for which the scheme is. But in this, the fund house itself invests in some other mutual fund, right? So this is a scheme where investment is made in other mutual fund schemes. These schemes could be of the same mutual fund or a different mutual funds. So SBI Gold Fund is an example of fund of funds lodged by SBI, right? So what you do in this, a fund manager or a fund scheme, this scheme belongs to the category where the investment is being made in other mutual funds, right? That is called funds of funds. Then comes the other scheme is, special scheme is called exchange traded funds. These are normally popularly known as ETFs. As the name suggests, they are listed and traded on the exchange like a common stock, the way share is being traded. Similarly, ETFs are also being traded on the stock exchanges. Like say for example, you may say BSE Sensex ETF. So in this, the fund manager will be investing only in the Sensex companies, and this ETF will be traded on a day-to-day basis, on a real-time basis in the stock exchanges. And the price, the way the shares are being quoted in the stock market, similarly the prices of this scheme will also be offered will be shown in the stock exchange during the trading time. So the biggest advantage is that they are traded on a day-to-day basis in the way the price is being revealed of other shares. Similarly, the prices are being revealed of the ETFs. So therefore, they can be bought and sold throughout the trading day as the price fluctuates, and can be bought on margin and sold short, right? Or traded using stop orders and limit orders. the way the investors can trade shares, similarly these ETFs can be traded, right? So there are different types of ETFs. It may be banking ETF, it may be IT ETF. Banking ETF means where the fund manager will be invested only in the banking companies and the ETF is being created, right? So banking ETF, or you can say NSE 100 ETF. So in 100 companies of the ETM, mid cap companies of the 100 companies of the NSE will be traded through ETFs. Commodity funds. These are all special schemes. Commodity funds, where the fund manager will be investing in the commodities like gold, silver, oil, right? So you know all these days the oil prices are going up, right? So if the fund manager feels the prices of oil will go up further, the fund manager will be investing in the oil. So a commodity fund is a fund which primarily invests in commodities, offering returns to the investor based on the market performance of the commodity chosen, right? So in India, gold commodity funds, equity, silver commodity funds, right? These are very, very popular commodity funds. Real estate mutual funds, right? So real estate mutual funds, they invest in the real assets, right? It may be residential complex, it may be commercial complexes, or commercial houses. So a real estate mutual fund is a mutual fund that invests in the securities of real estate companies. A large part of these funds goes into the investment in commercial and corporate properties, residential complexes and agricultural land. So these are means where the investment in the real estate, right? So normally in the real estate, it is an investment for a long period of time. The income that is being generated by those real estate, not only they buy and they sell it, they give it on a lease basis, right? So say for example, different real estate companies in India, what they have done is that they have given some of their real estate on a lease basis and they are getting a regular income, they are getting a lease income from that. So these mutual funds invest in those companies, right? And sometimes directly in the real assets also. Money market mutual funds. See, money market, what is money market? These are the short-term instruments, right? So these money market instruments, in the money market mutual funds, the investment in the money market instruments. These schemes generally invest in safer, shorter term instruments such as treasury bills. Treasury bills are the bills of the government of India, right? Treasury bills, certificate of deposits, popularly known as CDs, commercial paper, interbank call money. Return on these schemes may fluctuate depending upon the interest rate prevailing in the market. But these money market instruments, normally in the liquid funds or these funds where the investment is for a very short period of time, they invest in the money market instruments. But these money market instruments are very, very safe. Those investors who don't want to take risk, those investors who want to invest for a very short period of time, these type of investors invest in money market mutual funds. So top performing ETFs and money market funds: SDFC Sensex ETF, SBI ETF Sensex, Nippon India Money Market, L&T Money Market Funds, right? So this SDFC Sensex ETF is a index fund or ETF, SBI ETF is a index fund or ETFs, right? So and this Nippon India Money Market and L&T Money Market Funds are the money market instruments, right? So some popular funds are DSP World Gold Funds, Motilal Oswal Nasdaq 100 Funds of Funds, Edelweiss Greater China Equity Offshore Funds, DSP US Flexible Equity Funds, Aditya Birla Sun Life Global Emerging Equity Funds, right? I'm repeatedly saying that these schemes are just, these are names in the sense that these are the few schemes, which are quite popular in the market amongst that class. That's why I have categorized it here, right? So now I've made a things in this graph. What I'm trying to show is that there is a relationship between risk and return, right? As the investor is ready to take more and more risk, the potential return will be higher and higher. Like, for example, if you invest in debt funds, we have discussed in length about this in this lecture and the previous lecture. Debt funds normally invest in the fixed return securities, fixed income securities. So the degree of risk in the debt fund is low, but the return is also low, right? So those investors who are ready to take less risk they want safer investment, but they have to satisfy themselves with a lower gain also, potential gain. The return will also be low. So these type of investors should invest the debt fund. Then comes balanced fund. Balanced fund means where the investment will be in the equity and debt, basically, right? So equity and debt means in order to increase the return as compared to the debt fund, some proportion of the fund is being invested in equity. So the idea is to get a higher return as compared to debt fund, but since the exposure has increased or exposure has become in equity, so the risk will increase. Equity is a risky asset, right? So the risk will increase. Still, if you want to earn more, you can invest in the diversified large cap funds. Diversified large cap funds means where the fund manager will be investing in only large cap companies. Means normally, as a layman language, if I say large cap companies are those companies which high market capitalization, which are relatively lesser degree of risk. They have proved themselves over a period of time, and these are large companies or large conglomerates, companies like companies of Tata's, right? Companies of money like Reliance Industries Limited, HDFC Bank, TCS, Infosys, SCL. These are large cap companies. So here normally their fluctuation in the share prices of these companies are lesser as compared to the small cap companies. So but the return is greater than the balance fund or the debt fund. So but the risk is obviously more than this. So as you go up on the ladder, your risk will increase, so will be your return. Then comes diversified multi-cap funds. In the diversified multi-cap fund means where the fund manager invests in various type of securities, right? But it may be in the small cap, it may be large cap, it may be mid cap. Again, the risk will increase, but the return will also, right? Diversified small cap. So the fund manager will be investing in all different types of equities, right? Different sectors, either it is IT, whether it is FMCG, whether it is steel industry, textile industry, all sorts of industries, right? But the small companies. In the small company, these are companies are high risk, high return companies. So risk will increase, so will be the return, right? So as you go up and up, you find in the last direct investment. Direct means where the investment will be in the equity, or I'll say equity schemes. Purely investment is the equity scheme, and there is a investor invest only in the equity shares directly, not through mutual fund, through equity. So obviously the return can be more, but the risk level is also more, right? So these are the different types of schemes, friends, which we discussed. I'll continue talking about some other aspects of the mutual fund in the next lecture. Thank you very much.